My belief is that there will be a banking problem. There will be a bank that fails here before the end of the year that will be bailed in, not bailed out. And when that happens, the market volatility and premiums will go parabolic. It's happening, and it's starting to accelerate now, where you see these countries in the East start to buy more coins and bars than the countries in the West do. And you wait and see where there's one moment where the mainstream people in this country wake up and say, you see, that bank was just bailed in. Our neighbors lost everything. I believe that's what's going to happen. That will be the awakening. And not only that, it will start to immediately cull the banks, which will wake up more and more and more and more and more people. This will become all at once a crazy, crazy, crazy market environment for precious metals, because it is the only place to go right now.
In recent months, U.S. regulators resolved the insolvencies of three major banks: Silicon Valley Bank, SVB, Signature Bank, and First Republic Bank. The FDIC estimates these actions will cost its Deposit Insurance Fund, DIF, $31.5 billion, but half of that should be recovered from other big financial institutions. This development is closely tied to the provisions of the Dodd-Frank Act, enacted in 2010. The primary aim of this act is to safeguard consumers in the wake of the excessive risk-taking by banks that contributed to the great financial crisis of 2008 or 2009. A significant aspect of the Dodd-Frank Act is its stipulation that in the event of a bank's insolvency, instead of the government stepping in to provide a bailout, the bank is empowered to initiate a bail-in procedure. According to financial expert Andy Schectman, a looming banking crisis is anticipated to transpire by the end of the current year. He underscores the likelihood of banks opting for a bail-in strategy instead of the conventional bailout. Such a decision is expected to set off a chain reaction of events, leading to heightened market volatility and a surge in premiums within financial markets. Andy further points to a surge in the demand for physical gold and silver bars and coins in countries like Iran, India, and Turkey, which are now at the forefront of this market. This contrasts with Western nations that were historically significant purchasers of precious metals. Eastern nations are rapidly embracing precious metals as a hedge against the depreciation of their currencies. The People's Bank of China, PBOC, has been a key institutional player, significantly increasing its gold holdings by 155 tons since the beginning of 2023. From Andy's perspective, many individuals in the United States remain unaware of the imminent financial challenges, particularly concerning the provisions of the Dodd-Frank law and the concept of bail-ins. When people grasp the implications, he expects a panic-induced shift of assets from banks to precious metals, shaping a unique market environment. We will now bring you clips from Andy Schectman's interview with Liberty and Finance. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
In the first 8 months of this year, we've seen massive pickup in bar and coin demand in Iran, India, and Turkey. Here are the top 5 purchasers of bars and coins. China, number 1. Turkey, number 2. United States, 3. India, and Iran. So, 4 of these 5 countries, Turkey was just told by the European Union that they're not going to be admitted into the Union. And they said, fine, we're going to go another direction. They're going to go to BRICS. So you have 4 of the 5 top leaders or countries here in coin and bar purchases, either in the BRICS or soon to be in the BRICS. And I think the point I'm getting at is that, Iran and Turkey took the place of Switzerland and Germany. So the Western countries that have typically been buying gold and silver coins over all of these years are now being replaced by the countries in the East who are rapidly de-dollarizing. This is going on to the people. In June of this year, the People's Bank of China started to publicly encourage their people to make regular monthly purchases directly from the Shanghai Gold Exchange. What I'm getting at is this is becoming global. This is not just where the U.S. markets get to get all of the coins from the world markets, because the U.S. was traditionally the biggest buyer of these items. And now you have the world waking up who see things more clearly than the people in this country do. The thing that's very hard for people to understand is you got guys like Ted Butler saying there is a massive shortage on COMEX. And then people hear me talk and say, well, that's not the case on the retail level. It's hard for me to wrap my head around it. where everything I read says multi-year lows on the LBMA, on the Shanghai Gold Exchange, on the COMEX, product leaving, being backdoored off ETFs, product leaving. Those are the very sophisticated people. At what point does it translate down to our level? It hasn't yet. And it's confusing for me. It must be really confusing for people who don't follow this stuff as closely. But it's happening, and it's starting to accelerate now, where you see these countries in the East start to buy more coins and bars than the countries in the West. This country has no idea what's coming for them. They can't get out of the way of what they don't see coming. And when people who are financially literate, just illiterate as it pertains to the reality, but very literate when it comes to reading mainstream, they will find a whole new sense of panic and fear. It will be a religious experience when all of these people finally understand what the Dodd-Frank law is all about and what bail-ins is all about. And like that, it changes. And I know some people watching this would be skeptical of me saying that, talking his book again. But all I can tell you, as heaven and the Lord is my witness, in every bit of honesty I can come up with and sincerity, I believe that's what's going to happen. That will be the awakening. And not only that, it will start to immediately cull the banks, which will wake up more and more and more and more and more people. This will become all at once a crazy, crazy, crazy market environment for precious metals, because it is the only place to go right now if you want to remove counterparty risk and buy something that is not ridiculously overvalued, that has been considered wealth for all eternity, all of time. And the biggest money, the most well-funded money on the planet have been on a buying spree of unprecedented proportions. How much easier could it be to see the tea leaves if you open your eyes and look?
The U.S. dollar's domestic purchasing power has dropped 92% since 1933. Even with a moderate 1994 inflation rate of 2.7%, it's set to lose half its value by 2022. It's depreciated significantly in global markets, including 65% against the Deutsche Mark, 74% against the Swiss franc, and 76% against the yen since 1969. Andy believes that we are approaching a critical moment when confidence in the currency is at risk of sudden and insurmountable collapse. If the U.S. dollar were to experience a significant and widespread collapse, it would have profound implications for the global economy, financial markets, and everyday life. While a complete and sudden dollar collapse is improbable, understanding its potential consequences can shed light on the importance of a stable global monetary system. In response, BRICS nations, mainly China and Russia, may be stockpiling some of their massive gold production to support a new currency to rival the U.S. dollar. Moreover, central banks continue accumulating gold, and the demand for physical deliveries is increasing. This ongoing trend indicates a substantial change in the financial landscape where the gold, oil, and dollar markets could all experience significant disruptions. Let's get back to the interview.
And when confidence in the currency collapses, the impact is all of a sudden and insurmountable. What did we always say? Little by little by little by little, and bang, all at once. And at what point does it become very obvious that the world doesn't want to continue accumulating our debt when we are a country who has chosen debt and inflation over austerity and tough decisions? And it's becoming quite obvious. And I think we are reaching that point. And then you throw into it the geopolitical issues, the coercion, the sanctioning, the wars, choosing sides, along with printing, in 18 days, a half a trillion dollars. I mean, we are entering a period of time where we're going to cross over that Rubicon, and that's that all at once moment. And I think it's happening. I think we are on our way to it. And you look at what's happening with the BRICS countries. They're not only are they the ones that are buying all the gold, but they're also the ones that are selling all the treasuries. And they've just announced a 3-year de-dollarization plan officially to trade in local currencies like we're seeing right now. And the trading in local currencies has saved these countries billions of dollars already by ditching the dollar. China saved over $10 billion by not using the dollar in oil trades, by using the yuan in settlements with Russia. India saved over $7 billion by purchasing oil at discounted prices from Russia just since February of 2022. And they purchased $186 billion worth of oil from Russian suppliers from China. that was laundered through China. And then you got all of these other deals that are being made. And then you see like Gazprom Nefti, it's called, or Neft, Gazprom Neft. It's the second or third largest oil exporting firm in Russia. They said, we're done taking dollars. At what point does this start to really affect things? At what point does it start to gain momentum and these other countries and institutions in this BRICS network start to follow suit? So yeah, I think this, you add the seasonality into it, you add all of these things, and then a couple other things to mention, and then we'll be gone here. We're seeing massive outflows in metal continue. We're down to a multi-year low in gold on COMEX, down to 20 million ounces. Another 500,000 ounces went out this week. 200,000 ounces of gold out the ETFs. The markets, whether it be exchange for physical or outright deliveries off the London Metals Exchange, the Shanghai Metals Exchange, the COMEX market, they are being bled dry. And then you see gold in China being sold at $120 more an ounce than in the LBMA or COMEX. They are beginning to realize that by letting the price rise, it's not a supply-demand thing. It isn't. It's that they realize by slowly letting the price rise, they will siphon and arbitrage all the metal. That way, we are seeing a new system emerge as far as I'm concerned. And look, even the Shanghai Gold Exchange has seen the lowest level of silver that they've had since silver squeeze. Big deliveries keep happening, and the central banks keep buying. And the trend is continuing in 2023. So this is the same thing that we've been talking about, but it's accelerating. And little by little by little by little, logarithmic decay, bang. The gold market blows up. The oil market blows up. The dollar market blows up. What's the first one to do it? Don't know. What is the catalyst to the other markets when one blows? Don't know. But if you don't see this happening, you are not watching. Last thing, I promise. We are also seeing a concerted effort by the Shanghai Gold Exchange and the monetary, what am I trying to say, the Russian gold markets. There's a group, it's called the NRA, SFO NRA Corporation, and it has to do with these Russian, the Russian gold market. There is a concerted effort for these two to join together and to break the West, to break the Western price setting system. And that's coming. You're going to see these countries who have accumulated and are producing all the metal, they're going to render or expose the Western markets.
The bail-in prevented bank failures, but led to market instability and investor unease over fear that bail-ins would become more common and discourage bank deposits. This may drive a rising demand for assets like gold and silver, particularly in Eastern countries where they serve as hedges against currency devaluation. How are banks' adoption of bail-ins and growing interest in precious metals shaping the future financial landscape? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.